What's going on, guys, and welcome back to another video. So today we're going to be looking at what stocks and ETFs I'm buying this week on Trading212 and my reasoning behind them. And with all that being said, let's dive right on into today's video. So we can see on the left here on Trading212 we currently have €8,609 invested, are up €1,208, or that equates to about 16.3%, and we also have €105 in free funds that we're going to invest further today. We can also see by the 1 week chart on the left here that it has dropped about 2% over the last day or so. So I was up about 18% or just above 18%. So now we're currently up 16.3%. So again, this just poses great opportunities to take advantage of the slight drop as a long-term investor. Just a very brief synopsis on this channel or portfolio. So the main premise here is to dollar cost average and take advantage of dips. As a long-term investor, this will give you a better overall profit. To do so, I have 31 stocks/ETFs, and there's two main reasons for this. The first is diversification. So we can see on the left here just some examples of some of my portfolio pies. And the reason for this is because different sectors react differently to different market conditions. For example, there'd be no point in buying 31 stocks/ETFs all in one sector, because if the communication services sector is doing very well at the moment, that doesn't necessarily mean that the energy sector is. So that in that case, or in that example, I would be able to buy a lot more in the energy sector as the prices would be down, and I could leave the communication services pie ride. The second main reason why I hold 31 stocks/ETFs is because it gives more opportunities to dollar cost average. For example, if I just held all 5 of these financial sector companies here in my financial pie, it'd be very hard to dollar cost average. We can see Visa is up 13%, MasterCard is up 17%, and then we have the kind of 3 big companies here in the form of JP Morgan up 55%, Bank of America is up 60%, and Goldman Sachs is up over 70%. So as you can imagine, I'll be waiting a very long time to see Goldman Sachs go back into the red, as it's up nearly 71% at the moment. So the stocks/ETFs that I'll be investing in today, we can see that they're currently in the red, and that is one of the best things about dollar cost averaging. As weird as that sounds, sometimes it's actually good to see some of your stocks go into the red short term, because it leaves you buy these stocks at a discount, which in the long term will give you a better overall profit because you have a cheaper overall average cost. So as I said, we'll be investing a further €105 today. Now it's also worth noting, next Thursday I get paid, so I'll be depositing a further €400 then, and I will kind of trickle feed in that funds over the next few weeks as well. But again, we can discuss that on Thursday. For now, we're going to focus on the €105. So from looking earlier, I believe there's 3 overall stocks/ETFs in the red at the moment out of the 31, which isn't bad, definitely in terms of percentages. So we'll have a look through each of my portfolio pies very briefly. Again, we won't even discuss the companies on the right because I make detailed videos every Friday on my portfolio. So we'll just see which companies are in the red, and we'll kind of skim through these portfolio pies now. As my communication services pie is up over 30% at the moment and both companies are in the green, we're going to leave this pie for now. In consumer discretionary, we're up just under 5%, and we can see there's one company here in the form of Nike that is down 1.7%. So we're going to look at this company now. We can see we have just over 2 shares in Nike at the moment. Now usually I would wait until some stocks go below 3% at least before investing further. However, there's limited chances to take advantage of such stocks as Nike at the moment in my portfolio. So to even be down 1.7%, I'll take advantage of this slightly, and I'll probably only put in probably 25 of the €105 here. So we can see our current per average price is $133.96, the dotted line, and this is the 3-month chart here, and the current share price is $132.62 or cent. We can see here that this order is gone through in terms of execution, so we have to wait until the New York Stock Exchange opens at 2:30 GMT before this order is filled. Again, €25 is only going to get us about 0.22 of a share of Nike. However, as a long-term investor at dollar cost average, it's important. The best thing to do, first of all, is patience, and the second is to be consistent. So slowly trickle feeding funds into these kind of funds or stocks that are in the red is the best approach in my opinion. In consumer staples, all 3 are in the green, which I'm quite happy to see because over the last few weeks, the likes of Coca-Cola and P&G were in the red, but thankfully because of dollar cost averaged back then, they kind of reap the rewards now. So because we got a cheaper overall average cost, we're back in the green. So we're going to leave this sector for now. We then have the energy sector, which is up over 8%. Now this is a prime example of diversification. We can see, for example, the 2 old school energy style stocks in the form of ExxonMobil and Chevron are up 40 and 63% respectively, which are the complete polar opposite to how the iShares Global Clean Energy ETF is doing at the moment, down 9.4%. So over the 3-month chart, we can see the iShares Global Clean Energy ETF is down about 27% or so. So because we dollar cost averaged in as it went down in price, now this is one of the main reasons, or prime example, should I say, of why you shouldn't invest all of your capital at once to dollar cost average. Slowly, consistently feeding in your funds is imperative, in my opinion. For example, if you had €1,000 to invest into this ETF, and let's say you bought here at the £11.04 mark, well, if you put your full 1,000 there, even though it was dropping in price still, you got it at a cheaper price, it still dropped even further down to about £8.65. And if you already tied up all your capital in at this price up here at £11, you wouldn't be able to have got in at a cheaper price down here. So even though it has been going down and down over the last few months, I've been buying in very small amounts the whole way down. So effectively, let's say if I bought in today at £9.52, if it goes down further in value, well and good, because I can even buy more because I'll have more free capital next Thursday to take advantage of that. Or even if it goes back up in value, well and good as well, my money is going back into the green. So either way, in that approach, it's a win-win situation. And another thing I can't stress enough is that if you're a long-term investor, you need to look at the long-term charts. You can't just look at the 1 month or 3 month charts. For example, if we change it to the 1 year chart here, it looks like a lot different picture, and it's up over 95% since this time last year. We can see currently the dotted line here is my average price. It's sitting at about £10.30 at the moment, and we can see it's currently trading at £9.52. So at the moment as well, we have 30.95 shares and are down 9.45%. Now this isn't too bad considering we were down over 20 or 22% only a few weeks back. So being down 9.4 isn't the worst. And again, I did mention before as well the reasons for this. Two main reasons are their top position Plug Power in their financial error records. So obviously that's going to have a huge impact on the company. So hopefully down the line, this stock will be moved out or kind of re-weighted or rebalanced, should I say, in this ETF, and it will bring the ETF back into parity. And second of all is because of the overall clean energy hype has died down a bit, effectively kind of consolidating this overall price. But long term, I still feel that this energy sector ETF is a huge advantage and has a lot of potential going forward. So I have now invested that €40 into the ETF, and because the London Stock Exchange is already open, this order went straight through. And we can see even just by investing that €40 after cutting off over 1% of the red straight away off the bat. So again, this is one of the kind of ETFs that I don't want to jump all in, and at the moment I'll just slowly trickle feed funds in if it keeps going down in value. If we keep going down here quickly, ETFs are all in the green, so I'm quite happy with that, and we're going to leave for now. Now the ETFs are the one kind of sector or the pie that I will actually invest further in, even if they're in the green, because ETFs rarely go back into the red after if you hold them long term. So we'll come back to that in a later video. In the financials, we already went through these. They're all in the green fairly well, so I'm very happy with how the sector is performing. I think we were kind of lucky enough when we bought in at the right time. Healthcare sector, all three are in the green as well, up 13%. Same with industrials. Industrials are up 23%, and all three are very well in the green, so I'm quite happy with that. Materials, we have nothing. Now the next pie is the penalty stocks, which we're going to talk about now. So HighTide is the one and only penny stock that I hold at the moment. We currently have 261 shares. If you look at the 1 month chart, it doesn't look for good viewing. We can see here the dotted line on my average price is currently about 64 cents a share, and it's down about 23 or 24% in the last month. However, if you look at the 3 month chart, and again you need to look at further than the 1 month or even 1 week charts, the 3 month chart, they're up nearly 70% since this time 3 months ago, and we can see they're currently trading about 51 cents a share. Now, obviously, because I really do believe in this company, and I'm not a financial advisor, so you need to do your own due diligence, but I made many detailed videos on HighTide, which I'll link in the description below. And we'll have a very brief look at that kind of synopsis or summary on a Word doc in a few seconds of all the kind of catalysts and fundamentals that I believe are very good and very promising long term for this company. So I will be investing further, even though it's down. So I want to kind of get as close as I can to the 50 cent a share mark. And at the moment, this poses a great opportunity because it's down 24%. So I'm going to invest a further €40 here today, hopefully dragging this dotted line down as far as I can. So you can see on screen here on the left, I won't even go through these. You can kind of pause the video and have a brief look if you'd like, because I already discussed all these in prior videos. But in my opinion, HighTide has a lot of opportunity going forward. And it really is, I do believe, kind of the bigger investors are selling off this stock, effectively dropping the price drastically, which we've seen, and buying back on at cheaper prices. Now, the only thing I can see at the moment is dilution of shares, which again happens to a lot of penny stocks. But again, all of these fundamentals and catalysts on screen here pose great opportunities going forward, and I really do believe that at about 52 or 53 cent a share, HighTide is a steal. So I've invested at €40 now, and it will be executed once the OTC markets open later on, and that will bring me up to about 350 shares in HighTide. Now going forward, within HighTide and the iShares Global Clean Energy ETF, just like last week, I will give it a bit of breathing space and give it a week or so before I invest further, just to see what direction it's going and if there's been any big changes in terms of catalysts or news. And then just very briefly, as we're here in the tech pie, I'm very happy with how they're all performing. Again, we won't go through them, but they're all in the green, so I'm going to leave all those for now. And in the real estate pie, we only have the one company still in the form of Realty Income, up 13.88%. Now, I've mentioned in a few videos in the past that I do want to start adding more companies, especially into utilities and materials, as we currently have no positions in either of those sectors. And I also want to add at least one or two more stocks into the real estate pie as well. So I'm currently kind of still looking at companies that I want to add in there. So that's the 3 stocks / ETFs I'm investing into today. Now in tomorrow's video, it's going to be something a bit different. I'm going to be looking at how I'm going to invest going down the line when, for example, all 31 of my stocks / ETFs will go into the green, which is inevitable if we dollar cost average over the long term. Eventually all 31 will be in the green and there won't be any in the red to take advantage of. So it has been suggested by a few subscribers to kind of start looking at the 1 month or even 3 month charts and base my investing off that. So for example, let's say the likes of Chevron is up 70% at the moment. Well, if we look at, let's say, the 1 month or 3 month charts and it's down a few percent, then I might invest further in there. Obviously, the overall percentage will drop in terms of percentages, but my monetary percentage increase will only be of benefit. So that's definitely what I'm going to look into in tomorrow's video. So if you're interested in that, be sure to check it out. I'll put that up in the morning as well. So that's probably the end of today's video. If you found it anyway interesting or entertaining, it'd be much appreciated as always if you're new around here, if you consider subscribing to the channel. And if you could smash that like button, it would really help me and the channel out going forward. And finally, most importantly, if you have any questions, comments, queries or suggestions, please don't hesitate to comment below and I'll be sure to get back to you. And also, I'd be very interested to know what stocks / ETFs you're buying this week and your reason behind them. Thanks very much, enjoy your Tuesday, and I will see y'all in tomorrow's video.